Ladies and gentlemen, we are doing 28 November, October, November 2019, and as far as October, November 2019 is concerned, we have got question number 2. Eggs are Plenty Limited is a producer, package and distributor of organic eggs, and he has a 30 June year end. The company is passionate about delivering quality eggs that are farmed using environmentally friendly methods. The information here under is relevant to the financial year ended 30 June 2019. Due to the increased awareness on food safety and criticism on the use of antibiotics and hormones in food products, the demand for organic eggs has increased. As a result of the increased demand for organic eggs, Eggs Are Plenty Limited decided to invest in an additional delivery truck for the distribution of and delivery of eggs to different retailers. Since Eggs Are Plenty Limited could not afford to purchase a new delivery truck in cash, negotiations were entered into with Balem Limited, a neighboring milk distributor who had extra delivery trucks. On 1 October 2018, Eggs Are Plenty Limited entered into a 4-year lease agreement with Balem Limited, whereby Eggs Are Plenty Limited would lease one of Balem's Limited's trucks. The lease agreement contains a lease in terms of IFRS 16 leases. The specific truck to be leased by Balem Limited to Eggs Are Plenty Limited had a cash price fair value of 1.2 million and a remaining useful life of 4 years as at 1 October 2018. The truck had originally been purchased by Balem Limited on 1 October 2014 at a cost of 2,290,000 with a total useful life of 8 years and a residual value of nil. The useful life and the residual value of the truck remain unchanged, and Eggs Are Plenty Limited agreed with these estimates. Balem Limited has a 30 June year end. The lease agreement was signed and the delivery truck was delivered to Eggs Are Plenty Limited on 1 October 2018. The delivery truck was ready for use on the same date. Eggs Are Plenty Limited incurred and paid legal fees of 25,000 relating to the drafting of the lease agreement. In terms of the 4-year lease agreement, Eggs Are Plenty Limited would be required to make 8 biannual payments of 195,000 each, with the first payment being due on 31 March 2019. At the end of the lease term, Eggs Are Plenty Limited will acquire the legal ownership of the delivered truck subject to payment of the residual value guarantee of 146,974. Required to calculate the interest expense on the lease liability that will be recognized in Eggs Are Plenty Limited statement of profit or loss for the year ended 30 June 2019. Disclose the lease. The lease is not to the annual financial statements of Eggs Are Plenty Limited for the year ended 30 June 2019. Prepare all journal entries required to account for the lease of the delivery truck in the accounting records of Balem Limited for the year ended 30 June 2019. The journal entry relating to the current year depreciation expense for the delivered truck is not required. Journal narrations and dates are required for all journals. Alright, so ladies and gentlemen, this is the question that we have. We have got a question, question number 2. So we said it's October. It is October, November 2019 question, and we are doing question number 2. Alright, so what are we looking at when we are looking at question number 2? We know that this is a lease question. Alright, so as a lease question, what are we expected to do? Ladies and gentlemen, before one can decide to calculate interest, which is A, one needs to be able to calculate the interest rate implicit in the lease. So interest rate, which is not required, interest rate implicit in the lease. Alright, so what do you look at when you are looking at interest rate implicit in the lease? Ladies and gentlemen, you have your financial keys. So we have got our present value, PV of an asset, which is made up of the fair value of the asset, 1.2 million. All right, so we have got 1.2 million plus any initial direct costs incurred by the lessor if they are there. In our case, we don't have. N is equal to 4 multiplied by 2. We entered into a 4-year lease, but we are paying a biannual interest. So that's why we had to multiply it by 2. Future value, which is made up of guaranteed and unguaranteed residual value. In our case, we have got guaranteed residual value of 146,974. All right. Then we have PMT, which is equal to minus 195,000. All right. Compute I is equal to 8 using your calculator, 8% per 6 months. So if you want per year for it to be effective, it will be 8 multiplied by 2, which is equal to 16%. All right. Then you are done with calculating of your interest rate implicit in the lease. If you want to prove that whatever interest rate you have calculated, or in the event that you have unguaranteed residual value, you still need to do another calculation where you are calculating of lease liabilities. Lease liabilities at inception of the lease. So lease liabilities, we are performing the new calculation, but now we don't have 1.2 million. So we have N is equal to 8. Future value is equal to minus 146,974. PMT is equal to minus 195,000. I is equal to 8. Compute PV is equal to 1.2 million. Is equal to 1.2 million. So you can also calculate here if you want the right of use asset. Right of use asset. All right. In calculating your right of use asset, we know that it is made up of what? The right of use asset is made up of the amount of initial recognition of a lease. So the PV that we obtained as our lease liability, which is 1.2 million, plus initial direct cost incurred by X plenty, which is how much? 25,000. So our right of use is 1,225,000. It's our right of use asset. Ladies and gentlemen, we haven't answered the question, but we are looking at so question number A. A says calculate the interest expense. So interest expense. All right. So as far as our interest expense is concerned, ladies and gentlemen, with our financial calculator here present, you need to press amort, one ender, down arrow, one ender, down arrow, down arrow, down arrow. Then you get an interest amount for the first period being 96,000. Then we are saying the year end. Remember, our first installment runs on 31 March, but at year end 30 June we have got 3 months that are actually qualifying for interest, so we need to calculate also the 3 months to include them in our interest. So it's 2 ender, down arrow, 2 ender, down arrow, down arrow, down arrow. an interest amount of 88,000 080. That's the amount we get if we do that, multiplied by 3 divided by 6. Why 6, ladies and gentlemen? We said an installment does have 6 months. Alright, so we get 44,040. Then if we totalize these figures, we get an interest of 140,040. So this is the interest amount that is supposed to be included for part number 1, for A. For B, they are saying we needed to do a right of use asset note. So we are saying note number 2, leases. Note number 2 is leases. 2.1, it's right of use. Asset. Right of use asset. Then we are saying we have a delivery truck and a total here. Alright, so if you check on our previous page, ladies and gentlemen, we said right of use asset is 122,500. 122,500. So we are saying carrying amount at the beginning of the year. Carrying amount at the beginning of the year. Ladies and gentlemen, we don't have, because we entered into a lease agreement in the current year. Then we have additions. Additions. As far as our additions is concerned, ladies and gentlemen, that's the 122,500. 122,500. All right. Then we have depreciation. All right. So as far as depreciation is concerned, ladies and gentlemen, how do you calculate it? You say 122,500 multiplied by the number of months. So from October 1 up until 30 June, we have 9 months. So multiplied by 9 over 48. 9 over 48. 48 is equivalent to 4 years. Then we get 229. 688. That's our depreciation. 229 688, like this. Then we get carrying amount at the end of the year. Carrying amount at the end of the year, which is 995,313, 995,313 under total. So we have done our right of use asset not. All right, very important. So we are done with that. Then we go to the next note, which is also required, which is our 2.2. We are still proceeding with our leases, which is a maturity analysis. Maturity analysis of lease payments. To be paid at reporting date, or you can call it maturity analysis of lease payments outstanding at reporting period or reporting date. So we are in 2019, so we are recording this as at 2019. We have got future lease payments. future lease payments, and these lease payments should be undiscounted payments. Then we are saying for the period, for the year ended 31 March 2020, we have 195,000 to pay and 2 payments in 2020, which gives us 390,000. And for the year ended 31 March 2021, we still have 195,000 times 2, which is equals to 390,000. Then for the year ended 31 March. Sorry. Our year end is not March. Our year end is 30 June. My mistake. It is June. So June. Please correct. It is June. Alright. 2022. We have got 195,000 times 2 again. So if you check, we have now 246 plus the one that we have recorded, which is 7. So we are left with for the year ended 2020, 30 June 2023. For the year ended 30 June 2023, we have got 195,000 to pay plus a guaranteed residual of 146,974 to give us a total of, so here we say it is 390, here it's 341,974. 341,974. Then if we calculate the total here, we are getting 151,974. So this is our total future lease payments. Total future lease payments. Total future lease payments. Then less total future finance costs. All right. Then we get lease liabilities. Our total lease liabilities. Then the total lease liabilities, ladies and gentlemen, should be splitted into the current portion and non-current portion. It should be splitted into the current portion and non-current portion. So we can have that. So we're saying current portion then non-current portion. All right, so that's exactly what we need to do. So in calculating future, so we will start with future lease future finance finance cost. Future finance cost, we press amort 3 enter, down arrow 3 enter, down arrow, down arrow, down arrow. We get an interest amount of 322,894. Then remember, we need to add in period number 2 when we calculated our first question. We said the interest there when we said 2 enter down arrow, 2 enter down arrow. Our interest was 88,080 multiplied by 3/6. So the other 3/6 falls into this financial period. So we are now adding 44,040. If we add there, ladies and gentlemen, 322,894 plus 44,040, we are getting 366,934. All right, 366,934. Then we go back here, we put our total finance cost to be 366,934. all right, if we subtract this, ladies and gentlemen, we get our liabilities. So 1511974 should give us 11450 40. all right, this is the amount that we need to look at. Ladies and gentlemen, this is the amount that we need to look at. So if we say amount 1 enter down arrow, 1 enter down arrow, we get a balance. all right, our balance of how much? A balance of 101,000. If we add that to 40 with 44,040, that's how we get this amount. If we don't want to subtract, then the moment we get that, ladies and gentlemen, if we say so we have calculated this amount. If we say amount 2 enter down arrow, 2 enter down arrow, we receive an amount of our amount is 994,080. 994,080, and the principal amount there is all right. So we are calculating, we want to calculate the non-current portion first. So how do we calculate the non-current portion first? We say 3 enter down arrow, 3 enter down arrow. The balance that we get, if we do this, is 878606. Then the interest that is due from March to June, which will be obtained in the next period, which is 4 enter down arrow, 4 enter down arrow, down arrow, down arrow. When I'm putting 3 down arrows, I'll be trying to show you the last one for interest. The interest amount that we get there is 70,289 multiplied by 3/6 is 35,145. If we add this, we get a non-current of 913,751. 913,751. So non-current portion is 913,751. If we subtract the difference between these two figures, the difference between 141 1145,040 and 13751, we get an amount of how much? So let us subtract. If we say 1145,040 minus 913,751, we get an amount of as a current portion of 231,289, like this. So by doing so, ladies and gentlemen, you have recorded, you have actually accounted for your maturity analysis. Then you proceed. We want to look at total, which is 2.3. Total cash outflows. Total cash outflows relating to leases. All right. So we have got amount that is presented under financing activities. Presented under financing activities. We have got here cash payments for principal portion of lease liabilities. In our case, ladies and gentlemen, if you press one enter down arrow, our principal was 99,000. All right, so we have got 99,000 there. Then we have got presented under operating activities. Under operating activities, we have cash payments for interest portion of lease liabilities, which amounts to 96,000. Then we have got cash payment for legal fees, the one that we capitalized of 25,000. Then our total will be 220,000. So this is what the question wanted us to do for 23 marks. Then we go to the last part of the question. The last part of the question, ladies and gentlemen, they are saying prepare all the journal entries in the books of the lessor. So here we have got journals in lessor's books. All right. So when you are looking at lessor, ladies and gentlemen, the journal entries that you should have is on 1 October 2018. 1 October 2018, the lessor should have a journal to account for gross investment. So we have got gross, so debit gross investment in finance lease. All right. So how do you get the amount for gross investment? You say 195,000 multiplied by 8 plus 146,974. This is the total amount the lessor will receive in this case. So how much is it, ladies and gentlemen? How much do you get if you do that? You get an amount equal to what? Get an amount equal to 1,706,974. All right, you get an amount equal to that amount. Then you proceed, ladies and gentlemen. You have to credit an earned finance income, an earned finance income, which is a P&L. This one is statement of financial position. All right, so I will tell you how to calculate, or let me tell you now. To calculate the unearned finance income, ladies and gentlemen, we press amort. So we can do this. We can say unearned finance income. We say amort 1, enter, down arrow, 8, enter, down arrow, down arrow, down arrow. The total interest that you get from that is 506,974. Then delivery truck, we are selling truck. The delivery truck, ladies and gentlemen, should be at its carrying amount, which we can say 2290, the cost price to Bellam, multiplied by 4 over 8 remaining, which gives us 1145,000. All right, and we know that they sold it at 1.2, so they made a profit on disposal. The profit is 1.2 minus this, which is 55,000. And this is P&L. This is statement of financial position. All right. So here we are. The narration is recognizing lease and de-recognizing delivery truck. That's the journal that you do. Then at year end, ladies and gentlemen, at year end, how much do you have? At year end, you can have which is 31, or should we go to year end, or we go to the day we received the money, which is 31 March 2019, where we debit bank with 195,000, first installment paid. This bank is in statement of financial position. Then credit gross investment in finance, lease, statement of financial position, 195,000. All right, then you debit an earned finance income, an earned finance income with how much, ladies and gentlemen? With the total interest that we calculated initially, and we said the total interest was a total amount of 140,040, and we credit finance income of 140,040, but this one now is at 30 June 2019. 30 June 2019, because I actually added the two interest amount, the first one for 96 and the other one for 44. for me not to give you a lot of journal entries. So I have decided to do that. Or alternatively, one can do the unearned finance income as at 31 March, which is 96,000, and finance income of 96,000. Then you take another one, unearned finance income of 44,040, and your other amount of and finance income of 44,040. So that's exactly what you need. So ladies and gentlemen, this was the question for question number 2. Not so bad. I believe that you have seen that it was not so bad, but you need to be practicing for you to be able to understand what is happening.